Okay. All right, so let's begin. Let me share my screen. No, that's not. I don't like to waste time when I'm doing my own things. I just like to be brief and straight to the point. All right, so welcome again to the Cave of Lights. This bootcamp is a bootcamp we usually hold every year. It's an Elektronfx event. The academy holds 2 events every year. Right, the January is usually the bootcamp, and then in November we usually have the next Dollar Millionaire event. Right, so this is the third year where we'll be having this boot camp. This is the third year. We had the boot camp in 2022. We had it last year, which the topic of last year was, I think, recalibration. And then we're having it again this year. Theme of this is structure and liquidity. All right, so, my God, please mute yourself. Let me just handle that myself. All right, you can only type now, you can't unmute. All right, so I don't want the disturbance. If at any point you can't hear me or something, just type it in the chat box. I can see the chat box, but I've restricted people from unmuting because whenever you leave them to unmute themselves, people will start distracting you. Right. So let's begin. Let's begin. Let's begin. All right. So in the previous calls, the fourth man was gracious to introduce market structure. I think basically he just started from scratch. He started by introducing the different kind of trend. That is very important. That is one thing that many traders don't actually pay attention to. When they come to the market, they're just focused on taking a trade, right? They're not really focused on the actual trend of the market. Is it bullish? Is it bearish? Is it ranging? And one thing I always tell my private students is that whenever the market is ranging, you want to be staying out of it, right? You want to be staying out of the market whenever it is ranging, right? You want to only be trading when the market is either in a bullish or in a bearish trend, like the market is going up or is going down, right? That's basically what you want to be doing. All right, so now today we focused more on the liquidity aspect, right? I think fourth man has really talked about structure, so I'm focusing more on the liquidity aspect of trading, right? So I want to start by introducing what we call the physiology of a candle, right? Or you can call it the anatomy of a candle, right? So this is very, very important because understanding this thing will really give you an edge when it comes to trading the market. I think Forstman kind of introduced it yesterday when he was talking about how he frames his bias, and I want to really throw more light on that. Right? The recording for yesterday will be available possibly tomorrow morning, right? So I'll be putting possibly tomorrow morning or this evening, depends when I'm able to do that. So now let's start with the anatomy of a daily candle, or I prefer the physiology or the way it's moving parts, right? So let's start with the anatomy is like the structure, while the physiology is the moving part. Just the anatomy of a candle, right? Now, this is very, very important because when you open your chart and this thing I'm about to teach here applies mostly to the 4 hour it's most applied to the 4 hour daily and weekly. Right? These are the main time frames that we really look for this. Right. So now this applies to the daily, the 4 hour, and the weekly, right? Each time frame has its use, right? If you're using the daily, right, you're looking for intraday trades. If you're using for weekly, then you want to swing, right? So if you're using this, I'm about to teach you guys for the weekly, that means you want to swing. If you want to use on the D1, that means you want to take intraday trades. And if you're using on the 4 hour, it means you want to scalp, like quick 1:2, quick 1:3. That is what I call scalp. Just take a trade on 1 minute and you're done. You're done. All right. So now each candle has what we call the high. You know this. If you look at the candle, you have what we call the high. So I should make that black. Right. Each candle has its high. Right. Each candle has its low. Right. So this is what a daily candle looks like normally. Right. So now you can already know what these things are. This is the high of the candle. All right, I want you guys to understand. So I'm taking it gradually. So sorry, not that. So this is the high of the candle. Let me edit that. Sorry, settings. So that is the high of the candle, right? You know, this is the close. It depends on if it's a bullish or bearish candle. It could be a close or the open, right? Sorry. It could be it could be a close or open, anyone. So it depends on the if it's a bullish or bearish candle. Let's say it's a close, right? This is a bearish candle now. Let us type bearish, right? Let us type bearish so you can understand. So bearish candle simply means a sell candle, right? So this is a bearish candle. So that means, sorry, if it's bearish, the close is down. Sorry. So let me clone that. So this now becomes the open, right? This is a bearish candle. So this the open, and then we have the low down, right? We have the low down. This is very, very important. Very, very important to understand this. This is the low, right? And the easiest way to know this, okay, if you are using your MT5, or I think if you're using MT5 or you're using TradingView, if you just click on the candle, it's going to show you the open, high, low, and close, right? Like if I click on this candle now, you will see it. Like look at this point, you can see these levels here: open, high, low, close. That's what that means. OHLC. It means open, high, low, and close. And that's, many of you don't pay attention to that, but these numbers here are very, very powerful, right? Very, very powerful, and I'll tell you why. So just pay attention to this. On your MT5, you will see that at the top there. If you don't have it at the MT5, just go to your settings and activate. You see open, high, low, and close. That is what is obtainable on every candle. Those levels are very, very important. Now, the purpose of knowing this is because whenever the market is bearish, there's a tendency for the market to run above its opening price before going down, right? Now, usually, when the market wants to, let's assume we have the market is selling now, right? We have this candle to the left, right? We have this candle having its week here, right? And then having its week here, right? Now, when the market wants to really sell, you will see the market do something like this. Watch this. I got it. I want to listen to. Okay, let me just place it there. Okay. You see the market do something like this. Moments. I want to get this. Okay, this is a candle now. Right. The market usually do something like this. Take out the high of the previous candle before dropping low. I want you guys to understand this pattern very clearly. Right? Just follow me, because this is not something that many of you are used to. Just follow me and I'll take it slowly. Right. Now, this pattern can be seen as oversold. So when the market is bearish, right, and it wants to really sell, there is a very high tendency for the market to take out the high of the previous candle before dropping lower. This is what we refer to as what? A liquidity sweep of the previous daily high. So now, the high of each candle, if this is a daily candle now, the high of each candle is what we refer to as what? A previous daily high. And Mr. Fort mentioned it yesterday, that one of the kinds of liquidity we have is what we call a previous daily high and a previous daily low. So each candle has a previous daily high and a previous daily low. So now, when the market is bearish, right, and it wants to give its manipulation, it tends to go forwards the previous daily high before reversing. I will show you, Richard, after now. Now, the market tends to go forwards the previous daily high before reversing, right? Now, this previous daily high acts as liquidity. So whenever you are bearish and you notice that price has taken out the previous daily high on the daily chart, you can start to anticipate sales. So remember what I told you, what we're teaching you guys, structure and liquidity. Firstly, the market has to be structurally bearish, and then the liquidity has to give you the indication that it is ready to go down. And one of the ways that the market tells you that it's ready to go down is by grabbing liquidity, right? Because the smart money traders can only pair their orders with opposing liquidity. That means if smart money traders want, if a bank or a hedge fund, right, wants to take a trade, is going to want to pair its orders where it sees opposing liquidity. If you want to buy soya now, you can only buy soya from someone that is willing to sell soya. So let's assume that maybe a bank wants to buy soya on this chart, right? The only place he can buy soya is from where there are people willing to sell the soya to him. So now that soya happens to be what? The previous daily high. Because that is where people that are selling, all right, will put their stop loss. And whenever your stop loss is taken out, automatically you have bought. Now, this is something that many people don't know. If you actually trade, like if you actually trade, because some people are traders but they don't trade. No. These days, because of social media, we have influencers, we have traders, and then we have those that are in between, right? So we have influencers, we have traders, we have mentors, right? We have the ones that actually trade. We have the ones that just market. You know, I know Wally that she doesn't trade. All she does is to market, right? What is this guy saying? Give me a moment. Let me see what he's saying. I please close your app and open it back. Just close your Zoom app. Just close that. Open it back. It should be fine, right? So like I was saying, now whenever you take your MT5 and you take a trade. Just, just do this after this class now. Open your MT5, place a sell trade, right? Click on sell, and after um click on sell, and then after you click on the sell, after a moment, click on close position. You see that the MT5 is going to show buy before it closes. I don't know if you guys have observed that. Please, if you have noticed that, just type it on the chat. If you have noticed that what I just said now, that when you take a trade on your MT5, when you close it, you will see the opposite of your trade before it closes. Very quickly, you see buy before it's now closed. Have you noticed that? Yes, thank God. Okay, thank God you guys are understanding it. So now, this is logic, folks. We're not telling you stories because sometimes it seems as though smart money traders are just we have what we call a conspiracy theory. If you take an MT5 now and you click on sell and you close your position, what you will see is what buy, and then the market will close. Now, smart money wants you to buy at a a very bad price. So they have to do what? They have to force you. Sorry, smart money wants to sell the market, and the way they can sell the market is if you buy from them. So how can they force you to buy above there? The way they can force you to buy there is by doing what? By taking your stop loss. So once they all traded against you, they have bought, and then they can now sell peacefully. So this is a framework there. So if you're bearish and you see this kind of stock market take a pretty high, what do? You simply go to a lower time frame and look for what? Sell opportunities. It's that simple. And the reverse is the case for a buy, right? Sorry. The reverse is the case for a buy. Now, I just did an inversion. That's what I just simply I just did an inversion. So now, if you check your chart very carefully, I will show you guys examples. Don't worry, I'll show you guys examples. Now, watch this. The daily candle swept the low, forcing what people to do what to sell. Now, who in his right mind will be selling at his support? Who want to be selling down there? Nobody. But they have to force you to sell by doing what? Grabbing your stop loss. This is what we call a liquidity grab on the daily chart. So liquidity grab is not only when, this is very advanced stuff, and this kind of stuff you can't find on YouTube because they are hiding it. Because most of these things are being hidden because of the profitability of it. Most of these things you won't see it on YouTube, like you won't see it. It's people that actually pay for courses that actually get all this kind of information. And by God's grace, how I was able to learn all this is because I paid, right? You can't really get all these things for free on YouTube. You don't see it anywhere on YouTube because of the level of depth, right? What you will see is all these retail patterns. You won't see all these things being taught on YouTube, right? Because we paid, right? That is why sometimes paid stocks are actually more beneficial than free stocks, right? Because you won't really get all these in-depth explanations. So I'm not doing it for free just to help you guys. Now, the market does this, takes a liquidity and what reverse. So liquidity being grabbed is not only when market takes out equal highs. All right, it's not only when market takes out support or resistance. All right, this is not only liquidity grab. Liquidity grab is not only when the market makes a trend line and then blows it off. This is not only liquidity graph. Liquidity graph can also be seen when price takes out the previous daily high or the previous daily low, and this internal liquidity, and the markets will take out liquidity and then do what? Rally higher, right? So now that's it. So let me invert my chart back, right? So let us also look at example of this before I continue. I want to look at just see this thing on Richard. Let me just go to EU. So EU on a daily, what's my god, okay, I didn't go for. So EU on a daily chart. What's something now? EU on a daily chart. Watch something. Let me take out this. Watch something. Let us start from something. I'm looking for where the market was very trendy. All right. Okay. Now watch what happened there. When the market was setting up to buy, what did the market do? Took out the low of the previous day. What happened next? Blew all this low. Now, I want to say something too. Now, previous daily high is not only the most immediate high. Let me say this now. Let me just type it out. The previous daily high and low is not only the most previous one. So the previous daily low is not only the most recent daily low, right? It's not so a previous daily low can also refer to as 3, 4, 5, 6 days back, right? So up to 20 days. So up to 20 days can serve as previous daily low, right? So up to 20 days back can serve as what? Previous daily low. So take note of that. So um it's not only when it's yesterday's candle. No, that is wrong. Previous daily low also refers to the lows that are formed in the last 20 days. So you can see that, let me make this bold. Let me make this bold. My God, it's bold already. Okay, I think I just increase the font. All right. So now, so the previous daily low is not only the most recent daily low, right? It can be 2 days back, 3 days back, as long as it's 20. So just count to 20. By 20 days back, all the lows that formed can be regarded as previous daily. So previous daily is not only the low of the last candle, right? This is also a previous daily because why? It's a daily low that was formed in the previous day, but not the most recent day, right? So it's not previous recent. I mean, it's not recent daily low. No, it's previous days low. So previous day could be yesterday was the previous day. The day before yesterday was the previous day. So any day before the days previous, right? So this after that was the previous daily low. What happened? Rally higher, right? You can see another example here. Market did what? Why didn't the market just buy it? It first of all tripped off the previous daily low before then was rallying higher. Notice here again, before the buy set up, what happened? Market was ran through the previous daily low before then was rallying higher. The same thing here, you can see how it repeats, happens on repeat. Even here, look at this very carefully. Watch this. Watch this candle. This particular candle here, this one here. Watch this. Let me zoom again. Watch. Can you see how this took out what? The low first before then what? Rallying higher, right? You can see how this thing happens on repeat. Then when the market was ready to sell, you can see how it started taking out previous daily high before dropping. The same thing here before dropping, and then the rest is history. You can look at this. You can start whenever this thing happens, you can see very impulsive moves. Just watch the movement. Watch the movement. The market was very slow here, but when this thing happened, this clear liquidity grab. Can you see the market bought impulsively immediately? When this happen, you can see this buy. You can see the market always does that, right? So look at the example here. The Mason market took out what? The low of the previous day. Can you see how the market what? Started running immediately downwards, right? You can see how this is happening. Look at this. Maybe took this, what happened? It blasted and made a new low. Right? You can see this thing happens on repeat. Right? And of course, like I said earlier, you have to combine it with the trend. Remember, trend. Don't just taking out previous day. I'm looking for buys. Right? So now, understanding this thing can also help you to avoid certain trades. If I was trying to buy this pair now, and I saw that the previously low, previous high has been taken out, I would likely not take a buy again. Even if I was trying to scalp this and I see that PDH has been taken out, I would stay out because I expect the market to reverse whenever a previous daily high is taken out in a bearish scenario. So even if you like to scalp, you cannot just stay out of the market and you see this kind of setups happen, the market take out the previous daily high or low when it is in line with the trend. Like the market is bearish now, and the market takes out the previous daily high. That is an indication to do what? To stay off the market. Either you look for sales or you stay out. right? So just one takeout can give you what? Sell. So now once you see this happen, you can ask him to go to a lower time frame, look for sales, and then continue looking for sales until what? This low is blown out. Like this was the low that was formed there. If the high was taken out here, you can continue looking for sales until what? The next low is was blown out. So it's just like that. Very, very easy. So if you're bearish now, market is turning downwards, market comes now, take out the previous daily high, you look for sales, you sell until the market makes a new low, you wait for another one, market comes again, take out another previous daily high, you look for sales until it makes a new low. Just very, very easy. Once you start the liquidity grab, start looking for your sales until the market blows out this recent low here, right? Until the market blows this recent low, then you wait for another market to reverse again, give you that same setup, bam, and then you take the market down, 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 down. That is how you do it. And of course, you must look at what the higher time frame structure, right? You must mind where the market is coming from. You must always do top-down analysis. This is just the daily perspective. So now this setup can, if you saw this now, you cannot simply go to the lower time frame and look for sales. That's how it is. Just if you see this market is what? Market is bearish, right? So if you saw this market blow out this high, you can simply go to maybe 1 hour or 15 minutes and just look for yourselves. Look for sell opportunities, possibly to any low you can find inside the, whatever. You just look for yourselves, right? That is how to trade intraday with the daily candle in mind. It makes your trading very easy when you are using the daily candles. Now, someone was asking me, what about the weekly? So if you're using the weekly candle, that means you will be swinging. So if you're swinging, let's go to the weekly charts now. Although I don't use this because I'm not a swing trader, but it's still the same thing. I assume the market was bullish here now. Market was bullish all the way from somewhere around there, right? So now what do we have here? Okay, market has not blown in high yet. So this was where the market changed character. Market blew this high. That was where we had the break of structure somewhere around there. Market blew this high. Then, if you are looking to swing this trade now, we are looking for a very clear place where the market took out a previous daily low very clearly, right? So, looking at this, I can see this imbalance. Remember, it was always the top down analysis. So the imbalance is here. So that means this is the area you're looking at, right? This area, this is the weekly imbalance, right? That's a PDRA, right? You must always frame with higher time frame bias. You don't just look, like I say this 100 times now. You don't just look out for a low or high taken just like that. You must always look at the structure. Is the market at an imbalance? Did it hit another block? Those things are also considered. Don't not just it has taken out people you need to look for bias. No, you must look out for the structure. Okay, now where is the structure of the market? Okay, we have taken out this high bullish. What do we have again? We have what this imbalance here. So that's why we are looking for what buy. So now we had this imbalance here, and we're looking for what the setup. Where we look for what opportunities. So now what happened there? The weekly chart, what the weekly chart do? Can you see it? It blew the low of this. And what happened? You cannot simply go to maybe if you swing, you can simply look for what you can simply go to the lower time frame and then look for buy opportunities. And if you're swinging this, possibly looking at this high first, this previously high first for a take profit, and then consequently this will be your overall target, this high here, right? This high here, right? So if you bought here, this high will have been your first target, and then possibly if you want to hold, you can still hold till that, and then look at another opportunity that happened there. Very clear opportunity too. What if you miss that first buy? You remember you still had the overall target up here. What do we have here? We have what another blow of what the previous day low. Another one here. Can you see it? Market blew out the previous day low. What happened? And then bullish, right? So that is how you do it for weekly charts, right? If you actually swing, if you actually swing, if you actually swing, then you're using the weekly chart to look out for what that to run on liquidity, right? If you're using someone's asking, is it not compulsory for you to be engulfing? Madam Ngozi, yesterday, Mr. Ford said that when you see the engulfing candle, you go to a lower time frame and look for confirmation. That's what he said. And that's the sense I'm saying here. That once you see the sweep, you cannot look for what? Lower time frame confirmation. So it's either you see the engulfing or you look for what? Lower time frame confirmation. It's still the same thing. When there is a lower time frame confirmation, the market will usually give what? A reversal pattern. So it's still the same thing. That is the same thing Mr. Ford said yesterday. So an engulfing candle like this now, if you see this happen, you can go to a 4 hour and look for an engulfing, or you look for a 15 minutes break of structure. It's still the same thing. Break of structure, that's the same thing Fortman said yesterday. Like if you see an engulfing candle, you will likely see a confirmation on the lower time frame. That's what he said. Like once you see the engulfing, you cannot go to maybe 1 hour or 2 or 15 minutes and look for what a market structure break. It's still the same thing I'm saying here. right? So it's just that he prefers using engulfing candles, but me, I prefer looking at market structure break. So most times, if you see an engulfing candle, like this candle now, let me see. How far is this? Let me see if today you can take me there. Let me see. This is quite far. Oh. All right. So what day is this? Let me just take it here. Let's take it there. All right. So that is the candle. So I think I can go to a lower time frame on this. Let me see if today is going to allow me to go to a lower time frame. All right. So okay, yeah. All right. So this is it. So I think this is the November 2nd. Okay, this is a 4 hour of that particular move. Market blew the low, and then possibly inside there, you will look for what? Lower time frame confirmations. I think on the 4 hour, was there any engulfing candle here? I think just this rejection. I don't think it was an engulfing candle inside there. So this is a weekly chart, sorry. I should look at the daily, not weekly. I should look at the daily. You said one time frame down. Sorry. I should look at the daily chart, not weekly. Right. So this candle sweat liquidity, and then you can see this big candle, right? There's not really clear here. Right? I think that if you go to maybe the 30 minutes chart, we have seen the structural confirmation there, right? Or let's check the 15 minutes. Okay, I can't go that far. Can't go that far. Sorry. So I can't go more than 50. I can't go more than I can't go more than that. Can't go more than that. Can't go more than that. So I hope you guys get the point. What I'm trying to say. Where was I looking at stuff? Where was the place again? This. So you can see how this is occur on repeat. I can't even see where I was before. See, I can't go back that far. Wow. All right. So that is it. So you can see how this is occur on repeat. My market blue, low, blue. So let us look at a very recent example. I want to see where I can look for it on. So let me go back to the weekly chart. Let me use a very recent week. Let me use a very, very recent week. All right. Let me take out all this drawing. All right. So let's look at a very, very recent one. All right. So market was bullish. This took out previously low. Okay, let's also look at this one. All right. This was a clear market took out the low of the previous week before buying upwards. So the market took out this low and then started pushing upwards. Took out the low and then started seeing bullish movement. Let's go to this particular chart, this particular one. Same thing on the daily. So let me just do this way. Trying to get something. Let me take that off. All right. I just hope that this thing I'm replaying will not upset reading view. Because it gets upset when you start doing this replay stops. All right. Let me just mark that place. Okay, that's what I want to do. So that's the area I'm looking at. If there was actually any engulfing candle on the daily. All right. I think we had that. So that this candle, the boy of this candle was actually bigger than this previous one. So somehow that was kind of big bullish candle, right? And then so that let me check 4 hour. You can see the BB candles printed there. I think there's an engulfing candle here. This candle engulfed the previous candle, right? Some kind of engulfing candle here. And probably if you look at the 45 minutes or 1 hour, you have seen a very clear structural shift inside there. Just so I can go back there. Just give me a moment. Just want to get something straight. All right, where is the place again? Here. Okay. All right. So this what day is this? This is December 5th. Okay. So I know how to get it. December 5th. So let me simply go there. December 5th. December 5th. So somewhere around there, that is where I've seen what you're looking at for. Can you let me go there? Okay. That is December 5th, right here. So markets ran below. This is that previous weekly low. Markets around there. And then if you look very carefully, there was actually a kind of market short break. Right? It's very clear. Market took out this. That was the break there. Right? Market took out this and then can see the rest is history. Market started buying and then I think after this break, there was no entry until somewhere around there. Markets came back to this other block. This was the only clear entry here. Markets came back to this other block here. Right? So markets broke structure. Remember, we use bodies for break of structure. We use the body of the candle. Right here, there was no break here. Like the market did not close above. For me, I like to use the bodies of the candle. So the body did not close above this. That's not the break for me. So this was actually where I had a break. Markets closed above it. And there was no real retracement until this point here. And you can see the same thing also repeats on the 4 hour. You can see if even 4 hour, when 4 hour wants to move, you can see the 4 hour, first of all, it took out liquidity of the previous candle before it was blasting higher. So and now if you're sorry, this is 45 minutes, sorry. You can see the same thing also repeats on the 45 minutes. Before this impulsive move happened, you can see the market, this candle took out what? The low of the previous candle before it was rallying higher. So just it happens on repeat. But you're not using 45 minutes time frame to look for it. You're looking at the higher time frame, daily and weekly, because that is where um you get the bias, right? So that is very, very nice to spot bias, right? It's very, very nice. You can see the same thing here. 4 hour took out the low before they was blasting higher. So it happens on repeat. Happens on repeat. Market usually takes out liquidity before they was reverse moving to the intended direction, right? You can see the same thing here. 4 hour took out was the highs of the previous candles before they was dropping lower. So if you saw this liquidity sweep now 4 hour, you can simply go to a lower time frame now, right? You can see watch something now, right? So you can see how this happened. So if maybe there was a reason to go short there, then this was inside the weekly order block, right? Let's just examine this. Right, this move happened inside the weekly order block, right? Very, very clear. So this was the weekly order block. We are bearish. So watch this weekly order block, right? And if you want to see okay, supply zone, this was actually your supply zone. This kind of your supply zone. That was your supply zone. Why is it? Why are we bearish? Because why we have what? Market sweeping, closing below this. So that's a break of structure. Markets came to that point. Now, if you go to the 4 hour and you were using that same thing I just told you guys now, maybe you were just looking for a reason to go short, right? That would have been it. So markets came here. Market thought. Remember what I told you guys? He swept that liquidity. Remember you see this sweep. Did you have an engulfing candle? Yes. So I was nice one an engulfing candle here. If you like engulfing candles, now you can say, okay, I'm not really sure. Let me go to 30 minutes and go and confirm what I'm seeing. So I think on 30 minutes, you had a very clear um, structural confirmation there. All right, so you can see very, very clear. Too easy setup, so very easy. So you can see after the engulfing candle, you scale to a lower time frame, right? Very clear sell here. So what I see in the lower time frame, you can see what high, break of structure. So markets gave the change of character somewhere around there. There was actually a change of character here. So was there a retest? So markets came into this imbalance, right? So there was actually an imbalance setup here. So there was a 4 hour engulfing candle. You came to the 30 minutes time frame, saw this imbalance here. Can you see this imbalance here? That was actually the entry there. So the imbalance would have been an entry, and that was it. The market fell off the face of the earth from there. And if you trade ICT concept, I can see a breaker block here. So you can say, okay, even if you don't, this is a breaker block, this kind of is a breaker block. So if you trade ICT concept, that's a breaker block. If you prefer fair value gap, that would have been a fair value gap. If you trade um um you like trading, you like taking other blocks at the middle of the chart. There's actually something there as well on the 15 minutes. Let me just quickly go to the 15 minutes chart. I'll show you something there as well. I just want you guys to understand this thing. We have not even talked about intraday trading. No. We're just talking about bias. All I'm teaching you guys is just bias, how to frame bias. I've not even talked about intraday trading. So I think I'll wrap up intraday trading. So on the 15 minutes, you can see very clear there was actually a supply zone here. This candle was an unmitigated supply zone. So if this supply zone here, that was actually the entry. So I think this was the clearest entry. If you use lower time frames very well, that's move on the supply zone there. Why is it a supply zone? Why is it considered a supply zone? Okay, it's considered a supply zone because you can see movement from it. So after this, watch this carefully. Let me take out all this lipstick. Let's just take out lipstick so you guys can see why I'm calling that a supply zone. Now, what happened? Watch this. You can see that after this run up, what can you see? You can see this big peak displacement on the downside. So that tells that this is where the sell orders were injected, and that is what makes the supply zone. So if you like trading supply zone, that would have been your entry. Just very, very easy entry there. Although you can get tricked on this. If you are taking supply, that would be entry there. Stop loss above that supply zone. That would have been your entry, just somewhere around there. And that would have been an amazing trade. If you trade supply zone, that would have been it. 1:2.7. If you held it, would have been in massive profit up to now. Right? Have been in massive profit up to now. Right? If you miss that one, see another entry here. Can see this other block here. Watch this. This candle, what took out was the high of the previous candle. What happened next? It broke. So if you are doing that, the same thing there, that would have also been your supplies on that candle there. You can see the same thing there. Bam. Okay, what if you miss that? Another candle also gave an entry. This candle did what? Took out liquidity. And what happened? This heavy drop. The same thing that would have been a supply zone to you. So I also showed you guys how to identify supply zones. Supply zones usually come with displacement, like it comes with that momentum and then it breaks a low or a high. So you can see this one broke this low, and I can see how this one kind of reached through this low. Although it was not very clear, but it's close below it. So if you see close prices here, that's the market actually close below it. So let's see if I can go to a line chart. You see, it's actually did close below it. So you can see very clearly, it's close below that candle. That was a break of structure, very clear. So that is it. So those have been the entries we have made on EU. If you miss this supply entry, those have been an entry. If you miss this one, and you can see that there was an inducement formed there. So remember what man told you guys. See the inducement here. That was an inducement. So inducement before the other block, blah blah blah. Then, so I'm not here to teach entries. I'm also teaching you guys how you have gotten the trade. So even if you miss this one, no need to cry. Look for another similar entry. That displacement, energetic, in line with the trend. Your entries and your targeting was the low. So this is if you took your sell here. I'm targeting this low. If you took your sell here, I'm targeting this equal lows here. That would have been, I think, I'm very sure I took this trade. I'm very convinced I took this sell. Very, very convinced. I took this sell, this particular trade. It is very, very familiar. I think I took this trade, this one here, this particular second one. I'm not sure I took the first one, but I took the second sell, this particular one. It was very clear for me. I remember I took something like this. All right, so that is how to frame your trade bias. It's very, very easy. All right, very, very easy. Now, let me talk about the final thing. It's already 40 minutes into the call. Let's talk about the final thing, which is what? Intraday trading, right? Let me talk about intraday trading, and that will be all. So in this example, it's still that same thing I explained to you guys now, but it's in a very sorry, what's this? 4 hour. So it's still the same thing we have been talking about, liquidity, but this one is in a very intricate fashion. Right, let me make this auto. Voila. Why is that not show? Okay. All right. So let's talk more about. So now let's talk about intraday trading. Now, if you are in intraday trading, like you like to catch swings, right? Now there are things you should pay attention to. If you are intraday trader, right? There's a difference between a day trader and an intraday trader. And trader is more focused on scalps. Like he wants to catch a move maybe in one session. It's not wanting to hold a trade for so long. So now if you're a very low time frame trader, right? Pay attention now. If you're a very low time frame trader, like you like to play 5 minutes, 10 minutes, you have to pay close attention because the guys that trade lower time frames actually do a lot of work because they're always doing so many. That's why some people can't cope with it. I know guys that try to trade the way I trade, they can't just do it because of there's so many components to it. But I will also introduce this, and this is something I cannot cover in one call. Like you can see how broad this thing is. Like that topic I taught previously is something that is very deep. Like it's very, very deep. Power of three. I'm supposed to teach you guys what an accumulation is, what a manipulation is, what a decision is. I just have to summarize. So it's not something I can really teach in just one call. That is why sometimes it's best that you find someone um that knows a concept and then enroll for it. Because currently, like now, in my paid mentorship now, in our paid group, we have about I don't know, more than 100 videos like I have made during our course is 2021 to 2024. So there's no way I can teach what I've taught in over 100 videos in just 1 hour. That is why it's sometimes very important that when you see a place that teaches what you want, it's better you just pay for the course, because when you pay for the course, you can actually have access to the recordings that went in deep details. Like now, how I do is that, for instance, now like this topic now, I can use 1 month to teach this topic. Well, I'll use the first week to explain a part of it, then take it gradually. But I can't do that in a bootcamp because of the length of the scope. So that is why sometimes it's best to just pay for a mentorship. Like fourth man now, there are things that I'm very sure he could not teach to yesterday because of the depth. So it's not possible that you expect us to just explain everything in depth. So if you fall into this category, like if you fall into someone that is not really knowledgeable, right? If you fall into this category, you're not really you're not really knowledgeable. These are the category of people I'm talking to now. Not everybody, right? If you're not really knowledgeable about these things, like you don't really know how these things function, you don't really know what makes up an order block, you don't really know which imbalance is invalid. You don't really know all those things. Then I'm talking to you. If you are struggling, I'm not talking to you, right? If you are also new, like you're new to this concept, I'm talking to you. So if you're the only people I'm not talking to are people that are already profitable, right? People that are already doing well. If you're already profitable, if you're profitable, then I'm not talking to you, right? If you're already profitable, like you're doing very well in your trading, you just want to learn more, then this doesn't concern you. But if you fall into those that don't really know, like you just know some things, you know liquidity, but you don't really know what liquidity is all about, or maybe you're struggling, you know it, but you're not just doing well, or you're just completely new, then I will advise you to really pay for the mentorship, because that is where we actually have the time to teach you, right? Because there's no way that I can use 1 hour and teach you everything. It's not possible. I can use just 1 hour. It's not possible. So if you want to enroll with Fortman, let's meet Fortman. I think Benjamin Protocol. That's the name of his mentorship academy, right? So I'm not here to market my course. I'm just here to tell you guys what's what. This is how I grew this fast, because I paid for courses. So if you want to really, I think Fortman has a private group that is called Benjamin Protocol, right? That's what it's called. So if you want to learn more about what Fortman is teaching, you cannot simply message him and just pay and join, because I'm very sure in his private group, he has recordings, he has deeper teachings like ABC. You understand? So this course will really benefit people that are already profitable. They just want to learn one or two things. They don't really need it. But if you don't know what you're doing, you're struggling, you're new, then I will advise you the best thing you can do this January is to pay for any of this mentorship. Just meet fourth man, tell him, sir, please, I want to join your mentorship. But how much does it cost? You guys discuss, and then he enrolls you. All right, it's very, very beneficial for you guys. And then if you prefer the academy, we also have what's called Elektronfx Academy, right? So we have an academy as well, which has been running since 2021. So imagine having access to my videos of since 2021. So also have that as well. We have our paid group where we train people. I think last month, one of my students withdrew about, I think one of my students last month, he came to our meeting, withdrew about $2,000 last month from his prep account. So that's to show you guys that what we're teaching is working, right? One of the ways to know if a course is working is if the students are having results. One of my students last month, he cashed out this $2,000. How many of you cashed out that? Imagine that he did not pay for what I taught him. How would I have gotten it? So that is it. That's the advantage of paying for courses. You have access to those deep materials. And if you need someone to guide you, like now, if you have a question now, maybe something's not really clear to you, you can just reach out to me and I'll give you my time, because I'm not obligated to. But when you join our pay group, when you have an issue, you can come and meet me or meet any of the students, that we can easily attend to you. But when you're learning on your own, you have an issue, something is not clear to you. Who are you going to meet? Are you going to go and meet me? I won't answer you. So it's only when you're in the group I can really say, okay, this guy is under me. Okay, let me just help him, right? So time is very, very expensive. So if you want to get someone's time, you have to really pay for the course. That's why we pay for courses, because you have access to that person, right? The time. Person cannot give you his time. But if you're just depending on free things, you're doing yourself a disservice. So if you fall into not really knowledgeable, struggling on you, just pay for any of these courses. It's very, very cheap, right? Very, very um cost free, right? Just a little token and you can join us, right? So that is it. So you can meet Sportsman, Benjamin Protocol. If you want to learn more, we want him to hold you by your hands, like hold you by your hands, teach you every week. The same thing, the academy too as well. We have classes every week as well. So every week we have classes. Every blessed week we have classes. So if you want to access to those, just meet me or meet Sportsman, right? So that's all about that. So if you fall into these three and you don't want if you fall into any of these three and you want to move to profitable, then you really need to take those courses, right? So I'll end there and then let's continue. Now let's talk about intraday liquidity. Now, if you're an intraday trader, what you really need to pay attention to the very various things. Number one, you have to pay attention to what we call the Asian range, right? Asian range. You have to pay attention to what um previous daily high and low, very, very important as well. So that if this is for people that take lower time frame trades like 5 minutes, 1 minute, you have to pay attention to this thing. You have to pay attention to Asian range, previous daily high and low, previous session high and low. Very important. These are the things that you will not learn on YouTube. You can't learn all these things on YouTube. They won't teach you, right? Previous high and low. Sorry, previous session. So very important. So you have to pay attention to Asian range, previous day high and low, right? Previous day high and low. Very important. So Asian range, previous day high and low, and then previous session high and low. Now, what is the you must also pay attention to what the New York midnight, right? So you have to pay attention to the New York midnight. So you have to convert it and know the time. Currently, I think the New York midnight is I think it's by 6 a.m. Nigerian time. So 6 a.m. Nigerian time, that's the New York midnight for now, because we are having daylight savings time in March. So I think in March it's going to change to 5 a.m. So by March it will change to 5 a.m. But currently it's 6 a.m. because we have what's called daylight savings time. Daylight savings time is it happens once a year. That is when the time goes forward or backward in some countries, right? It doesn't happen in Nigeria, but in some countries, their 6 a.m. becomes 5 a.m. at a particular period. It's what we call daylight savings time. It doesn't happen in Nigeria. It happens in countries like Europe, London, Germany, all those London and US countries, right? California, all those areas. It happens there. But it doesn't happen in Nigeria. So currently, the New York time is 6 a.m. in our time. If you're in Nigeria, that is the time that we use to that. So these are the things you have to pay attention to. Now, what's the purpose of this? Firstly, if when you come to your chart in the morning, the first thing you want to do, this is also the breakdown now. The first thing you want to do, right? Remember that you must consider the structure of the market. Are we bullish or bearish? What is the structure of the market? Are we hit our order block? You must always do top-down analysis first. I think I should not start it there because some people would act like they did not see it. So they must add it up there. So we must consider what the top-down bias, right? So top-down bias, right? So top-down bias before you consider all this. So if you have determined the market is bearish, maybe it's coming from an order block, all those things, you have a bearish top-down bias. Market is bearish on the higher time frame. Then you cannot simply go to the lower time frame. First, you want to identify is what the Asian range. So the Asian range occurs, you want to identify the Asian range. And Asian range is between what? Is between what? I use 7, some people use 8, but it's between 7 p.m. to 12 a.m. New York time. That's Asian range. So New York time, you have to add 6 hours to get started. So if you add 6 hours to this, that will probably be that will probably be I think 3 to 6. Yeah, I'm not sure. 7, 8, 9, 10, 11, 12, 1. Okay, sorry, 1. That will probably be 1 to 6 a.m. Nigerian time. So you have to pay attention to this. I'm also helping you guys to convert it. So Nigerian time. So NIG means Nigeria. So you want to have what? The Asian range. So what are you doing with Asian range? You are marking the high and the low. So let's assume that the market comes and inside the East Asian range, and the market something like this. Makes it high and then just something like this. So you have gotten the Asian range high and the Asian range low. So what do? You mark it out. This is my Asian range high and this is my Asian range low, right? So you mark the Asian range high and low. You want to have that. So you have to use the time in this time intervals and mark it out on your chart. And the next thing you want to do is that you want to know the New York open time. So whenever the market opens or New York open time, the market opens. Now, what are you expecting? If you are bearish, now you have to mark that New York open time. You mark it. This is my New York open time with a horizontal line. You mark the time at the New York opened. Now, if you're bearish, remember what I told you guys earlier, that if you're bearish, once the market do what? Once the market was give that run on liquidity before dropping lower, right? Remember what I told you guys earlier, it's still the same concept. Remember, if you're bearish, you want to see this candle run the high of the previous candle, right? But in this lower time frame perspective, you are not looking at candles, you're looking at what structure. Remember that a daily candle, right, is actually a series of candles on the lower time frame. So this whole thing now, I want to carry this candle thing and now paste it on a chart format, right? So now, when the market takes out this candle, you want to look for sell. So that is the same that applies there. So now, when the candle opens, if you're bearish, you want to see price run above that open price and possibly take out that Asian high and I'll give you what your sell opportunity. This is the classic London session setup. So this is what you're looking for, what in the London session. If you're bearish, you want to see price run possibly above the Asian high and then give you that sell setup. That is the same thing that is occurring on this other corner. The same thing I've explained on this candle format. We are now pasting it on the chart perspective, right? What is happening here? We are copying it and pasting it on the chart perspective. That's what we're doing. What is happening on candles is now in the chart format. This is what's happening. This is the interpretation of this whole thing I've explained with candles. This is the interpretation on the lower time frame. So now, the market should take out the Asian high and then give you what? A sell confirmation. Now, you cannot look for your sell opportunities. Say, okay, Asian high is taking. You cannot look for what your sells. You took your sell here. What is that? Jesus. Okay, let me manipulate it. So this is 2700. So let us manipulate that quickly. 2700. Stop loss. Sorry. 2700. Let us adjust that. Sorry. 2700. All right. So now you have what your stop loss there, and now you cannot target. Remember another point. Remember you mark Asian load. So don't forget that's mark Asian load. So Asian load can also be what another area of reference. Can I say okay? Let me mark Asian load as well. You can look to you say you cannot take your profit at Asian low if you wish. Why is not going up? Now I lie. This is 1 2 So 1 2 6 9 60. Let me just put it in. Take profit level 1 2 6 9 60. I guess. All right. So now you cannot say okay. Let me sell from here. Remember, you also look at Asian low. So now this is the model. When the market is bearish, you should do what? Remember what I told you guys. This same thing now. Market should take a liquidity before they were dropping. So now that is it. Take out the Asian high, you can target Asian low or TP. And if maybe there's another liquidity down, maybe as soon as maybe down here we have what? Maybe the previous daily low is down here. Maybe somewhere around there, have previous daily low. Let's just say that maybe at this level here, this is the previous daily low. Now let us type it there. Maybe this is our previous daily low, PDL. All right, previous daily low. Now we can say, okay, that's our previous daily low. Okay, let's mark it. So you can now say, okay, when market take out Asian low, you can maybe take partials, maybe close your profit in half, and maybe move your stop loss towards break even. And then you cannot target what the previous daily low as overall targets. Simple. That is the model for a bearish scenario when you're bearish. This is the lower time frame perspective for the London session. So for London, this is basically what you're looking at for. The market will do this. Now let's assume that we have a scenario where the market has been selling. Okay, we now take out what the Asian low, right? And then we now enter New York session. So when you enter New York, simply do the same thing. You mark what? You mark, remember you're marking the open time. You're marking the okay, forgot something here. You also mark the London session too. So to mark the New York open, the London open, and the New York open. So let me type it out. The times you should mark. You have to mark what? The midnight open. You have to mark what? The London open. And also mark what? The New York open. These are the three things you're marking out with a horizontal line. So a vertical line. So the vertical line. So these are you're marking the midnight open, London open, and the New York open. Right? So now when you have done that, what do you do next? Now we now enter New York session. Now Remember the same thing that happens here. The same thing happens here. So for the New York, you should always expect price to blast through the previous session high. Now, remember I told you guys here. Don't forget this I told you guys. Previous session high, previous session low, and all of that. Remember I told you should always take note of that. Now, this happened during London. Let me type it so you guys understand this. And I'm ending here because I've told you guys if this is new to you, then you really need to join the paid group because we have gone in details with this. But if you're already profitable and just want to learn, then no problem. But if you're really you're just new to all these things, you really need to join the paid group. It's for your benefit, so you can get a better and deep step-by-step explanation to all this. So now you have your London session here, right? You have the New York open here. New York can open now. This is the New York. So now, immediately we enter New York session, what happens? Automatically, all these highs are forming, and that becomes what? Previous what? Session highs. And now this low now becomes what? A previous session low. So we have to automatically that low now. This low now becomes what? A previous session low. Right? You can also type it out. So that now becomes what? A previous session low. That's say PSL. That because was a previous session low, right? Because why? This low formed before before the New York session. Can you see it? So this low formed before the New York. Is that because of a previous session low? Why all these highs formed before the New York? And because was all previous session highs. And remember that we're looking for what? This same scenario, market blasting liquidity before they what? Taking our trade. So now, if you're looking for sales in the New York, you want to see market also do the same thing. Take out what? Liquidity. This is a liquidity area. That is it. Blast it out. You can call it an inducement. Very good. You can call it an inducement. So you can say, okay, inducement taken out. And then this, you can say, okay, this is my other block. Maybe this is another block up here. You can say, okay, other block up here. And then you can simply say, okay, this is an unlimited other block. Inducement. Previous session high taken. You can look for a sell here. So remember, you want to see the taken out. So you can say, okay, let me sell here. Oh my God, this is doing this thing again. My God. This is okay, let me just type it in again. Sorry. 127 stop loss level 12700. I think so 12690, I guess. So 19. Not quite sure. Alright, so that's it. So you cannot say, okay, let me put my stop loss here. And then what happen? Yeah, cannot target what? First stop loss will always be where? Cannot target what? Oh my God. Okay. Thank God. Cannot target this as your first take profit. That's previous session was the first take profit. Concerning target D as my first TP. And then overall cannot be what the previous daily. So you cannot say, okay, let me target the previous. Remember what I told you guys? Liquidity. Don't forget this. Previous session high and low liquidity area. So looking at for if you're taking intraday. Now you can see why many people run away from intraday trading. It takes a lot of understanding. That is why I won't beat my drum, but I'm one of the best lower time frame traders out there because I'm able to put all these things up. I'm looking at all these things. That is why most times it's very difficult to trade the way I do because I'm looking at all this. I'm looking at session liquidity. I'm looking at Asian high. I'm looking at Asian low. I'm looking at all these things at once. That is how I trade as a lower time frame trader. That's how I trade. And it can be very, very difficult for many people to trade. So if this doesn't work with you, then you can opt to use just higher time frame structures. You don't need to be doing all this. But if you want to be taking lower time frame trades, then you have to put all these things in place. Know the Asian range, know the London high, know all those things. Know your previous low. Then you can say a sell here. When the market hits here, you can take your partial and then maybe go break even here. Because why? The first low is as taken, which was the previous session low. Next thing you can say, okay, overall TP was previous daily low. That is it. So that is the whole concept. That is the whole concept from the higher time frame perspective. So that is basically what we're talking about. So I think this, and can you see that I didn't even talk about key zones now? Okay, now let me just put one thing. Let me just chip one thing now. Let me just chip something now. One of the reasons why I love currency market is because we have a specific time we look at it. So now all these setups you're looking at for London setups. So this let me just give you the time to look for setups. So London setups, you're looking at it between what between 8 to 11 a.m. Nigerian time. So this is time for setups. So looking for setups between 8 to 11 for Nigerian for London setups. Then for New York, this for Nigerian time now. So this is just how to make your trading is because some of you are wondering what time will I be looking for setups? This is setup to look for setups. For New York, he has a specific time window to look for setups. We're looking at setups between what? 1 or possibly just say between 2 a.m. So 2 p.m. that is New York open. So between 2 p.m. to possibly 2 p.m. to 6 p.m. That is when you should stop looking for setup. And then if you trade indices, you can see setup maybe if you like late evening trades, you can also look for setup between 7 p.m. to 9 to 10, right? That is if you like take late trades. But there's not usually volatility during this time period. So you can look for stuff between this time too. If you like lower time frame trades. So for New York, you can look for stuff between 2 to 6. But the time you will see most of the movement is between 2 to 6. So if you only want to trade New York session, you should pay attention to this time very well because that's when you see the movement, right? Between 12 and 2, market is usually a bit slow. It's not really too fast. Between 12 and 2, between this London close and between this period, market is usually a bit slow. It's not that fast. But when you just see 2 p.m., 2:30, you see market begin to move very quickly, especially on indices. Now, can you say that I couldn't talk about indices because indices has its own way of trading it. That is CFD indices like Nasdaq, all those pairs, they have their own way of trading them. And you can see that I couldn't talk about those things. But for the paid students, I've talked about those things to them. I've explained this to them. So that's why you really need, if you are struggling, you're new, or you don't understand this concept, then you can simply meet me and join the paid group. That is where you're going to get step-by-step teachings and you can be held by the hand. But that is basically it. So I think I just look at just one example and then we call it a day. It's already 1 hour into the call. I don't want to overstretch. All right, let me just look for just one example and then we run it. We end it for the day. Just for us one example. I think I should make this visible. Visible, sorry, visible. Okay, make this visible. Why is it not showing a deck? Okay, is it network? Why are my charts not appearing? I don't know what's wrong with the chart. Please, can you guys hear me? Please, can you guys hear me? All right, so you can hear me. Why is my chart not loading up? Why is it not coming up? So I want to just show you guys one example. I don't know why my chart is not coming up. Why my chart is not coming up? Okay, let me just reload. Let me reload. Let me just try to reload. Okay, let me see if it's going to come up now. Still the same thing. It's not coming. It's not showing. So that is going to be an issue. Oh, I thank God. So that's shown now. So let me just quickly look at um okay. This market has been really, really ranging, like for reals. Market has been ranging. All right. Okay. So based on 4 hour, I can see that the current trend of 4 hour was bullish, right? Why am I saying it's bullish? Because why am I saying the 4 hour is bullish? Because I can see the markets breaking highs. So this one I can see market breaking highs. When the market is breaking highs, I usually see that's bullish. Market was currently because the market is breaking highs. You can see highs being broken. So I can really say okay, market is bullish based on what I can see at this end. But overall, this market is bearish because market took out this low. But on the this is what we call structure within structure, right? I've thought that I cannot go into details on that for now. I just want to show you guys the lower time frame stuff, right? So 5 minutes is where we'll start with. So let's mark it out. So this was on Friday. So Friday, what do we have on Friday? We are bullish, right? So let us mark that Asian range. Sorry, that's Let me take that out. So let me just mark. So if you are bullish, let me just mark out something. All right. So on Friday we had it's remember 7 to 12. So this was Thursday. Okay. So mark Asia range. So I think let me just quickly mark Asia range. So somewhere around there. I think 7 it was here. 7 was this candle here. 7 to 12. 12. Where is 12 here? So I think that's our Asian range. So inside that range, you can now spot your high and low, right? You can spot your high and low, Asian high and Asian low. So you can mark it as Asian high, right? And then you can mark this as Asian low. So this is Asian low. You look at the lowest point in that period, inside that box. Look at the highest point and the lowest point. That's your Asian high and Asian low, right? So that's your Asian liquidity. And then I think we are kind of bullish on this. So let me just quickly look at something. So looking at this, I can see okay, now remember we are bullish. You want to see price run below. So market run below, right? Although this did not hold, for me, honestly, if it were me, I would have been trying to buy this because markets ran below the Asian low here, and there was some kind of break of structure here. So for me, I would have bought. This would have been a loss for me. Would have possibly bought maybe somewhere inside here. I would have been looking to take out this Asian high, right? Which did not happen, right? So that is fine. Market gives losses too. Now the reason why this did not happen is because this break of structure happened and tapped another block. All right, so always knows that when the market gives a BOS and it taps into another block, right, be very, very careful with it. Like you can see, market gave a BOS and it tapped into another block. So be very careful with this kind of trades too. I'm very, very careful with this kind of trades. The market break structure and tap into another block. Very, very careful with it. So that was the reason why this didn't hold. Right. But if maybe the market was able to break, like clear this other block, like close above it very well, then so those would have been a loss. Like would have been a loss for me if I was taking time to take this trade, right? So that is fine. So now what do we have here? So where's our midnight candle? Remember the same thing we are doing. Where's our midnight candle? Midnight is somewhere around yeah. This is midnight. Yeah. So this is a midnight candle. So we want to see market run below that. So that is us. So London session was somewhere. Where was London? So London was somewhere around there. So London opened there. Okay, I see where the market took it out. I see why. So this is the reason why market took it out. This low formed before the opening of the London session. So you can see why that did not hold. Remember I told you that whenever you enter a new session, the highs and low formed in the previous one becomes liquidity. So that's why the market did not respect this. So I've seen the reason now. Can you see how intraday trading becomes very, very interesting, right? You have to, this is why you to excel as an intraday trader, you have to be paying attention to a lot of things. Like you have to look at so many things if you want to excel as intraday. Unless you want to be swinging like Fort, because Fortman is more of a swing trader. So if you don't want to be swinging trades, because you have to pay attention to all these stocks. So now we're looking at this. It didn't hold because this formed before the London session, right? London opened there, but this slide will look formed before London. So market took it out. That's why it dropped, right? So now what happened next? So London opened, and then if you look very carefully, I think we had some sort of interest here. So we had this on what do we have here? What the market play of this? Okay, so we have this order flow here. There's an order flow here. So markets hits that order flow. Why is the order flow? It's the last push down before what the market gave the impulsive move. So this is a kind of demand zone, right? I think first one told you guys about demand zone yesterday. That is, it really looks like a range, and you see what that impulsive move. So this is a kind of demand zone. You can see after this down move, you can see how the market bought like straight up, bottoms up, right? So market hits there. And I'm very sure if you look at lower time frame, I've seen some kind of 1 minute break or straw inside here. I'm very sure there's 1 minute something here. So let me just quickly see if I can check 1 minute inside. Let me just quickly check if I see the 1 minute play here. Let me see what happened inside on the 1 minute. Let's see if I can see that. It was a 1 minute break there. So very, very clear. Shush. So can you see that? Um so on markets lower, remember we're using the close prices. So markets close above this 1 minute high. Remember, I used BS for break or structure, so that was break or structure. Markets close above that candle. So we use candles for break or structure. We use the body. The body closed above this. That was a break or structure. Markets came back, retested it, played whatever you played. Their imbalance. So we are not simply playing an imbalance. If you check the 3 minutes time frame, it's still clear on 3 minutes. You can see it's close above it. So that would have been it. So if you played, maybe you played this imbalance between here, that would have been that. So now always note the last imbalance before another block. So this is the last imbalance before this last bearish candle, right? So that would have been your entry if you play that. And you can see the reason we are playing that is because of that demand zone on the higher time frame, right? So this is all top-down analysis. So you can see how markets came, hits it. It's very clear. You can see the other block very clearly there. Sorry. You can see very clearly. Last down candle. You can see how miss that last down candle printed, right? You can see that explosive move to the upside, right? Last down candle, explosive move to the upside. So that was why the market did that. So that is it. So this happened before New York. So you can see how that played out nicely. So market just did that, blah blah blah, and then ran for our Asian high. So now, where did New York session open? It opened somewhere around here. This 8 o'clock. So New York opened here. So New York opening here simply makes what? This high was a previous session liquidity. This high becomes what? A previous session liquidity. This high becomes what? A previous session liquidity. And what we have here? Our overall was Asian high. Remember, Asian high is one of our targets when we're taking the trade. So if you bought here, maybe you'd have taken partials above this previous session high, and then you'd have held it, and then I've seen markets came back, played around a bit, and then consequently went for what? That's Asian high. So that is it. So now, why the market go for Asian highs if it's random? So you can say this is not random. The Asian high was already marked beforehand. You can see how price came and still took it out just as anticipated. So that is how the intraday market print, right? I know how this might get over your head. So the recording for this will be on YouTube, possibly tomorrow. And so if you have any question, just do it to type it in the chat so I can wrap up this session. It's 1 hour and 14 minutes. So if, like I said earlier, if you're quite new or struggling, just want to send me a DM so I can join the paid group. It's very, very important I join the paid group so you can have someone to hold your hand. If you have an issue, the person can attend to your questions and all of that, right? But if you're okay, then that's good. So someone say, okay, how about if price didn't take out our previous daily high? Because previous daily high is above Asian high. I don't understand your question. Okay, let me just try to use a chart to illustrate it. So he's saying that what if let me just take it out. So saying something like this, let me just start. He's saying that if maybe we have our previous daily high here, and then Asian high now forms here, right? Let me just get the question again. Let me just say, what if price didn't take our previous daily high, but it's okay? Okay, I get it. So now we have our previous daily high here, and then we have our Asian high here. Right, we have Asian high here. And then price now took out the previous, price took out Asia, but it didn't take out previous daily high, right? Now, one thing you should note that you have to look at the distance between where the market opened towards the daily high. So if the daily high is very, very far, like from where the market is, like let's assume that Asian high is just here, right, and the daily high is very far, it doesn't have to take out Asian high, right? The only times we anticipate previous daily high to take us when there's a proximity and the market opens, like let's say the market opens somewhere like very, let me assume that the market opens like the market opens very, very close to the Asian high. So I mean to the somewhere like this place. The market opens there. Like you can say Asian high is very, very close to the previous daily high. So you can say the market can do something like that and then it drop. But if there's a kind of a considerable distance between that Asian high and the previous daily high, market doesn't need to take it out. So you have to look at the proximity of where the market opened to where the Asia of so I mean you have to look at the proximity of where the market opened to where the high formed. And of course, this your question can be solved by going to your chart and backtesting. So this is not something I can I can answer everything at once. So these are things you can also open your chat and go and test it. The question sometimes you can really go to chat and test. So like I said, if the distance is quite far, like the previous high is very far from the open price, market can just choose to take out Asia, that is, or just take out Asia and just drop off. Right? It doesn't need to take out previous high. But if it's very, very close, like the proximity is very close, like this candle now, this candle now. Let me something like this now. Like this kind of candles now. Something like this. You can see how this candle, let's look at this candle now. You can see how this candle opened very close towards the previous daily high. So these kind of examples are times in which the market might just want to go for the previous daily high. But if the market is small like this now, look at this candle now. Just watch this. Now, watch this. You're bearish now, and the candle opens here. You can see the high is very, very far. Like this Asian high is the daily high is very far. So are you going to wait for price to buy all the way up here? No. So in cases where the market opens quite far from that Asian high, sorry, very quite far from that previous daily high, you can just use the Asian high to just take a trade and then target the previous daily. So you can just simply look forward. This is your daily low now, right? You can just simply look forward. Asia to form, right? Markets takes out that Asian high and then give you a sell, do what? To take out what? This previous daily low. And now take note, when the market takes out the previous daily high, it doesn't need to do it again. Like it mustn't do it every day. It has already done it on this day. It mustn't do it every blessed day. It doesn't happen every day, right? The previous daily high taken out is actually an indication that a sell wants to begin. Like it's kind of okay. This move wants to begin now. Start looking for buy. Look at it. Look at the example now. This candle took out this high, this low, sorry. And what happened next? The buy started running. So it's kind of an indication that market wants to start buying. So once this happens, it mustn't do it every day. You can also simply use Asia for other days. So if you catch this, that is fine. If you don't catch it, just use Asia. Remember what I told you, this is called intraday trading. So you can also simply use Asia for the intraday trade. Just use Asia to be catching it, take out lows, target it, and that is simply how to go about it. So it's not compulsory that you must take out the high. Just one high being taken out can serve as a move for the whole week. Just one. Look at this example now. Look at this as well. Market took out the high. What happened? You can see how market sold for 3 days. So it must not be every day. You're not been catching sales, just Asian high taking, you take your sales, and then that is so I think that's ending the call here, and we'll continue tomorrow, right? So as I said, if you want to join our paid group, just send a DM to me. All right, and we're actually giving a special discount, 20,000 naira off, right? You're going to be paying 20,000 naira cheaper, like a discount. We're going to be taking up 20,000 naira to join us, right? So if you want to join us, just send a DM, and we'll catch you in tomorrow's meeting. So have a wonderful evening. Cheers, and God bless.